This is Jody Trana with Chapter 1, Part 3 of Principles of Accounting. The accounting equation provides the basis for all of the accounting process. The accounting equation is assets equals liabilities plus equity. The premise with the accounting equation is that assets have value, and people have rights to those assets. They could be people inside the company who have rights to the assets, that we call equity, or it could be people outside of the business who have rights to the assets. Those we call liabilities. The accounting equation is the foundation for all of our accounting transactions. We have account categories within the accounting equation, and equity itself has revenue and expenses built into it, which are two other accounting categories. Each of our account categories also has a multitude of accounts that we use to organize and categorize our transactions. I'm briefly going to review for you the way that we as accountants compile financial statements. Our financial information is initially organized into a trial balance. You'll have a lot of practice developing trial balances throughout this semester. If you look in the left-hand column, you'll see all of the accounts in the business listed. We usually list all of the accounts in the business by the accounting categories, starting with assets, then liabilities, equity, revenue, and expenses. And that's how these are listed here. The trial balance shows debit normal balances on the left and normal credit balances on the right. We'll talk a lot about that. You can also see that the trial balance balances. That means that the left column totals up to the same number as the right-hand column. We take these numbers and we use different accounts for different reports. We'll start at the top by taking our assets, our liabilities, and our equity accounts, and we'll move them over one column into our balance sheet column. Now we have prepared a balance sheet. As you can see, the balance sheet represents the accounting equation. Our balance sheet always has to balance, and you can see that it also balances here. It balances because I have put a number in for the current year earnings. I'll show you where that number came from. First of all, let's take a look at the second report. We're going to take the accounts that are in the revenue category and the expense categories and move them over into our income statement columns to prepare an income statement. When revenue is greater than expenses, as it is here, we have a net income. And our revenue is higher than expenses by the amount of $7,050. That means we have net profit or net income of $7,050. If our expenses were greater than our revenue, then we would have a net loss. The $7,050 of net income is transferred from our income statement into our balance sheet in order to make the balance sheet balance. That $7,050 is in a category or an account called current year earnings. These columns here represent debits and credits. Debits show on the left side of an account and credits show on the right side of an account. We'll talk about this a lot, but between the accounting equation and debits and credits, this is how we get our double entry accounting system. We talked about the two primary financial statements, the balance sheet and the income statement. There are a couple of other reports that we use quite a lot in accounting. One is the statement of owner's equity, and the other is the statement of cash flows. The income statement, as you can see, reports profits and losses. The statement of owner's equity reports the equity and what makes up the equity. The balance sheet shows our resources and our obligations, including our total equity. And the statement of cash flows shows a report of where the cash has come from and where the cash has been paid to through the period. One of the things that you need to understand is that 3 of these statements show information based on a period of time. That means you might see an income statement for a month. You might see a year's worth of information on an income statement. The statement of owner's equity you'll see for a year's period of time. And the statement of cash flows is probably most often for a month or a quarter or even a year. The balance sheet is a single point in time. That means we don't see a period's activity within the balance sheet. We see what we have and what we owe at a specific point in time, such as December 31, 2000. During this course, you're going to be given a lot of opportunities to prepare financial statements. Most often, you'll be given a list of accounts and their balances, and you'll be asked to prepare a balance sheet or an income statement. Just a few tips on the assignment coming up. Whenever we do transactions for a business, you need to think about these 3 questions. First of all, what account or account category does it affect? So accounts are like cash, inventory, accounts payable, capital. Those are accounts. What account category does it affect? Assets, liabilities, equity, revenue, expenses. Second, does it increase or decrease that account? Very soon we're going to start saying, do we debit or credit that account? But right now we're talking about increases and decreases. And third, after we make the transaction, does the accounting equation stay in balance? For your homework, you may find that the Excel template that's in Canvas is very helpful. You will need to do a lot of addition, and you'll need to keep your accounting equation in balance. You may find that it's easier to use the Excel template to do the math for you. If you haven't used Excel before, this might be a great opportunity for you to give it a try.